When looking at a chart, you have to ask yourself, which way does price want to deliver? If you're the type of trader that sits down at the charts and gets lost in all the movements of the market, that I'm here to clear up your confusion. Overall, not knowing which direction the market was going, this led to a lot of bad habits like overtrading and overleveraging. Understanding market maker models is essential for any serious trader. Ignorance of these models can hinder your grasp of market dynamics and ultimately your trading success. This video aims to significantly enhance your understanding of algorithmic price delivery. Let's dive in. Is price action random, or does it happen in a planned way? Some people think it's all random, while others believe there's a strategy behind it. The reality is that most of the time, algorithms are running the markets. This gives us a chance to use what we know about how prices move and liquidity to trade effectively alongside these algorithms. That's really what matters. Market maker models, or better known as Mmxm, are schematics which represent algorithmic price delivery in the most objective manner possible. To define market maker models, we must first understand what they represent. Market maker models show true accumulation, manipulation, and distribution, power of 3. If you don't understand the meaning of PO3, watch this video. From now on we will refer to market maker models as Mmxm. There are two models that we are primarily interested in for this lesson. Market maker sell model, Mmsm, and market maker buy model, Mmbm. I will focus on the market maker sell model, but everything applies the same for the buy model. In an Mmsm, we're gauging the likelihood of a price swing high to go down. The market goes up to create a selling opportunity. We can participate in the rally up because we know what higher timeframe level the algorithm is likely to reach to create a sellout. Ask yourself, if I'm looking for shorts, what levels in premium am I expecting the market to reach before a sell-off? That is the level we will be using as a draw on liquidity for the buy side of the curve. Ideally, a swing high, relative equal highs, or an imbalance. Remember, price is fractal and Mmxm is present in every time frame. So the first stage of a Mmxm is original consolidation. The Mmxm begins with a consolidation phase where relatively equal lows or equal highs are formed. Retail traders often interpret these equal lows or equal highs as strong supply or demand, leading them to place stop-loss orders just below or high. This is what I use as a draw on liquidity and target for trades. Original consolidation can be identified as being old highs or old lows such as PDH or PDL, PMH or PML, PWH or PWL, or intraday highs or lows such as Asian high or Asian low, London high or London low. Once we get an obvious candle close above it, we're likely going to break out higher. The second stage of a Mmxm is a ranging phase where smart money accumulate orders before expanding up from original consolidation in a Mmsm, or down from original consolidation in a Mmbm. The range of opportunity goes from the original consolidation low to the predefined DOL. After the break outside the original consolidation, we can get a return to the original consolidation, and the next impulse leg is the first stage of reaccumulation. It could retrace into an FVG, OB, or any PD array. This would be the first obvious buy. In some cases, the return to the original consolidation can also be the first stage of reaccumulation. After the first stage, we can get a second stage, and this is the second opportunity to buy. Usually, the move from stage 2 to terminus is going to be faster than from stage 1 to stage 2. Any of these three price points could be a good buy, but you only need 1 and 2 to find good setups, since you might not see the initial buy at 0. We expect the first stage to form anywhere between the 20 to 30% of the expected range of opportunity and the second stage beyond the 50%. If the market has already run up above 50% of the expected range of opportunity, assume that we're only going to have one stage of accumulation. If we only get one stage of accumulation, we're probably in a parabolic price run. It's gonna be in a hurry to get to that level just to go down. The HTFs tend to have two stages or opportunities to go long before it reaches the premium array. The LTFs tend to just go in one move up. The HTF is the weekly, daily, and even 4-hour chart. Anything less than 4 hours can create just one opportunity to get to the premium array, and then it creates the reversal. Third stage is when price runs to take out a key swing high or taps into a HTF-PD array. Once we reach the HTF premium array, we start looking for shorts. The initial draw on liquidity is going to be the low of the original consolidation. ASMR in an Mmsm is essentially picking tops in bearish conditions, often referred to as a turtle soup, selling the highs. We can pick tops in bear markets because we are already expecting the market to move higher just to move lower, unlike picking tops in a bullish market. The low-risk sell is usually any short taken before breaking the low of the highest stage of reaccumulation on the buy side of the curve. The range of opportunity goes from the high of the smart money reversal to the low of the original consolidation. We can get two stages of redistribution on the sell side of the curve, and terminus would be some measure of a run below the original consolidation, usually in the form of a HTF-DOL. Once we break below the low of the last stage of reaccumulation prior to taking out the premium array, once that breaks, that's when we look for the first stage redistribution. The second stage redistribution is usually a stronger move than the second stage reaccumulation in a Mmsm because the market is already bearish and has the potential to move below the original consolidation, while the second reaccumulation move higher is a controlled move to a level we expect seeing a return to before a sell-off. For shorts, we always look to the buy side of the curve for a previous level of reaccumulation. When we go below a previous level of reaccumulation, we expect price to pull back up into the down close candles of the swing low in the buy side of the curve and act as resistance to move lower. If it overlaps with an area of reaccumulation on the buy side, I'm gonna trust it's not gonna close the gap. To have a good market maker, we need to pay attention to three criteria: HTF-PD array, MSS and CISD. HTF-PD array and Mmxm. HTF level can be ANYPD array such as FVG breaker block, order block, mitigation block, volume imbalance, rejection block, old high or low. Once we reach any higher time frame level mentioned previously, breaker block, order block, FVG, etc., I look for a lower time frame Mmxm. This means that if we reach, for example, a 4-hour PD array, I will then focus on the 5-minute structure to play Mmxm. First, you should also understand that change in state of delivery creates real order block. Second, change in the state of delivery means real change in order flow, which confirms smart money reversal. Key concepts of smart money reversal: liquidity purge, HTF-PDA, CISD or OB. Market structure shift or MSS. This occurs when there is a clear change in the market structure. Mmxm framework can be found on all time frames, but I personally use it on weekly, daily, 12-hour for bias, 1-hour chart for intraday market structure, and 15 or 5-minute for intraday entries. Okay, let's go to the chart and give a few examples. Here we have the 1-hour chart of the Dow Jones. The price has formed a buy-side market maker model. After forming the original consolidation, the price entered the daily fair value gap, where it created a smart money reversal. It formed patterns like CISD and FVG, leading to the capture of sell-side liquidity, and original consolidation movement under Mmbm is complete. Here is an annotated example of a Mmsm. Entries for me personally are always either at FVGs or breakers. Also with Mmsms, my SL always goes above the high that took liquidity, or an ITH. And this is an annotated example of a Mmsm. This models examines the influence of smart money on market dynamics. By analyzing the trading patterns of these major players, retail traders can better align their strategies with the direction favored by market makers. Okay, if this video was helpful, please give it a thumbs up, as it greatly supports the creation of more content like this. Thank you for watching, and see you in the next episode.